Hi, and welcome back to Accounting 161. This is going to be Unit 4 of the course. We're still working on the accounting cycle, and we're going to look at closing entries for our accounts. In this lesson, I want to look at the concept of temporary and permanent accounts and why we need to close the temporary accounts before we begin the next accounting period. And the last thing in the accounting cycle is the post-closing trial balance, which means that we're ready for the next accounting period. And then at the very end, this is not a formal part of the accounting cycle, but I want to talk about correcting entries, meaning if we identify an error that we have previously made in our accounts, we need to make correcting entries to make our financial reports true. So I'm going to end our discussion of the accounting cycle on correcting entries. So now let's take a look at step number 8, journalizing and posting closing entries. So what exactly are closing entries? Closing entries mean getting the accounts ready for the next accounting period by bringing all income statement and dividend accounts to zero. And to explain this a little bit better, I'd like to just talk a little bit about the concept of temporary accounts and permanent accounts. I've said here, income statement and withdrawal accounts are considered to be temporary accounts that will revert to zero at the end of the period. Balance sheet items are considered to be permanent accounts, and they will retain their balance from the previous period. We do not close permanent accounts. And so just by way of a summary, temporary accounts, revenue, expense, and dividends, and then permanent accounts, all assets, liabilities, and equities. So the balance sheet stays, the income statement is reverted to zero at the end of each period. There are 4 steps to closing the accounts or the books, and I'm going to go through them one by one. I'm going to use the example of Smart Computers Inc. that I introduced to you earlier on in the video lessons. The first step then is to close revenue accounts to income summary. And I'm going to pause right here for 1 minute to explain income summary. Income summary is a temporary account that we will use to close the books. It is not a part of the chart of accounts, and we're going to see in a few minutes that income summary, by the time we finish closing our accounts, will revert to zero, and that's always the case. So let's just see how we can use income summary to close the books. So the first step for Smart Computers Inc. then, to close the revenue accounts to income summary, and this is my journal entry. I'm going to debit service revenue, and I'm going to credit income summary. Let's take a look at step 2, to close all expense accounts to income summary. And so in this example here, what we're going to do then is we're going to credit all of our expense accounts, and the balancing debit will be to income summary. And you'll see that leaves us with a difference between credits and debits, and we'll see what we do with it in the next step. Step number 3, we're going to close income summary to retained earnings. And so up to now, we have not used this account called retained earnings, but now we are going to use it. And I've said here, income summary will have a credit balance if we have net income. But there's also the possibility that we may have a net loss as well, and we'll see how we treat that. First though, for Smart Computers Inc., I'm going to close income summary by debiting that amount, $87,800, and I'm going to credit retained earnings. If the company had a net loss, our journal entry would be the exact opposite. We would debit retained earnings, which is, remember, this would represent a reduction in retained earnings, and we would credit income summary. And finally, close the withdrawals or the dividends account. And remember, as I said, dividends are not an expense, so we do not treat them the same way as expenses. We'll close the withdrawals account separately. And for Smart Computers Inc., this is the transaction that we would journalize. We would debit retained earnings, and then we would credit dividends. Now we have finished our closing entries. For a quick summary of closing entries, I'd like to just illustrate this. First, we will close revenue accounts to income summary. Second, we will close expense accounts to income summary. And third, we will transfer that amount to owner's capital. Remember that we will not change or affect the owner's capital account. We will close income summary to retained earnings. Retained earnings are still owned by the owner, but we will treat them separately. And if you go back to the very beginning of this module, we talked about the fact that retained earnings is equal to revenue minus expenses minus withdrawals. And then finally, we're going to close the drawings or withdrawals or dividend account, and that will go also against retained earnings. Now we have closed our books. And finally, step number 9, preparing the post-closing trial balance. So to start off, what is the post-closing trial balance? It's the trial balance with only permanent balance sheet items shown. All temporary income statement items, revenue, expenses, and dividends will be zero. The principles for a trial balance is the same as what we have used before. It should have a title, and then we're going to show our assets, liabilities, and equity accounts according to their normal balances. And this is what we've done for Smart Computers Inc. I just want to bring your attention to one item, that is the retained earnings. And so, as I said earlier, up to now, we have not used the retained earnings account, but now we are using the retained earnings account. And as I said, retained earnings is revenue minus expenses minus dividends or withdrawals. And once again, as always, our trial balance should balance. Debits should equal credits. That's the first check that you should make to see if you have done this correctly or not. Now, this brings us to the end of the accounting cycle. We have now gone through the 9 steps of the accounting cycle. Before we finish, though, I have one more topic I want to cover. Making correcting entries is not a formal part of the accounting cycle, but we all make mistakes. And so this section will look at how we can go about correcting our mistakes. So what are correcting entries? They're journal entries to correct a previous data entry error. As we're entering journal entries, it's important to remember you cannot go back and change a journal entry. And especially if you're using an application, is once you've entered a journal entry, you cannot go back and change it. So if you have made a mistake, you need to make a correcting entry. We should do that as soon as we find the error. If we're lucky enough, we find the error in the same period in which the initial transaction occurred, and nobody will know that you made a mistake. But there will be other times where you find the error after you've closed your books, and you may need to restate your financial statements if the error is significant. And so quite often you will see in the news that some companies have to restate their financial statements. One of the reasons may be some pretty major error that they made in their previous accounting records. There are 2 approaches to making correcting entries. And I'm going to try to highlight both. The first one, I call it the two-step process, where we reverse the incorrect journal entry, and then we will prepare a new correct journal entry. It's a two-step process. It takes a little bit longer to do, but it's also more conservative. This is the approach that I prefer to take because it's very easy for me as well as other stakeholders to understand. There is a shorter way though. I call it the one-step process, where you simply prepare a journal entry to correct the error and make all of the account balances correct. I'm going to go through each of these approaches in a little through a few examples. So let's take a look then at an example here. Chip and Dough Company. They discovered the following errors that were made in February. So on February the 15th, a payment of salaries of $600 was debited to supplies, wrong debit, and credited to cash, both in the amount of $700. And so obviously this is a mistake. We need to correct it. So let's take a look at the two-step approach first. With the two-step approach, I'm simply going to zero out. I'm going to reverse the journal entry that was made in error. And that's my first step. And then I'm going to start all over again, and I'm going to make the proper journal entry. And in this case, the proper journal entry then should be a debit to salaries expense for $600 and a credit to cash for $600. So I look at these journal entries. They're very easy to understand, and I can see why I did both. Now, before I move on, I'd like to take a look at the one-step process. The end result of using the two-step process or the one-step process should be the same, but it's up to you in terms of what you would prefer to use. So in order to reverse the transaction and make all of the account balances correct, this is the transaction that I would use. I would debit cash by $100. I would debit salaries expense by $600, and I would credit supplies by $700. This will adjust the error, and it has the same effect as the two-step process. It's a little bit quicker, but as I said earlier, it's also a little bit harder to understand. And me being so conservative, I prefer the first approach, the two-step process, better because it's better, easier to understand, and easier for other stakeholders to understand as well. Let's take a look at one more error. So this time around, Chip and Dough Company, they discovered another error in February. On February the 20th, the purchase of supplies on account for $860 was debited to supplies and credit to accounts payable for $680. So the debit and credit is okay, correct, but the amount is incorrect. Let's take a look at the two-step process first. With the two-step process, I'm going to reverse the original transaction. So we made the transaction debit and credit 680. I'm going to reverse that. And the second transaction is I'm going to correct it and using the proper amount of $860. This time around, if you want, the one-step process might be a little bit faster. All we need to do is to increase the debit to supplies by $180 and increase the credit to accounts payable for $180. And you will see that the end result of both of these approaches is the same. When we transfer our amounts to our ledgers, the ending balances will be the same. It's just up to you in terms of which approach you like the most. Okay, pat yourself on the back, everyone. We have now completed our look at the accounting cycle, units 1 to 4 in the course. And now we're going to look at a few other topics. They're related to financial accounting, but not a formal part of the accounting cycle, namely internal control, cash management, and also financial statement analysis. That will come in the next video lessons. See you then.